How do you see markets from here?
Post December, we may see oversupply of crude. There are chances that crude can actually fall below.
What are the sectors or themes that you are very bullish and you think the growth is there?
We are going to see more compounding and better opportunity of wealth creation.
How do you see Indian IT sector right now?
There is clear-cut overhyped situation. So right now, because nobody owns AI stocks, everybody is positive about it. Real research is stocks after you own it.
Yeah. Anupam, thank you so much for giving me your time.
Thank you, Rahul.
So now US and Iran has signed a MOU, right? And oil prices have come down below 80 now, and consistently they have remained below 80 since the time MOU has been signed up. Now, how do you see markets from here?
Okay, so of course this worry has gone, right? And it was a very major problem for us in terms of currency and dependence on oil import, energy cost, etc. So if you keep it aside, I think from a medium to long term perspective, even from a short term perspective, because we are seeing a good earning tailwind coming ahead if you look at Q2, Q3, Q4 numbers. So I'm quite bullish.
Okay.
So if you take a medium term view or if you take a very long term view like 10 year, 20 year, in fact that 10 year, 20 year I'm more bullish on India than medium term.
Right.
Because we have still some short term problem to hiccups to solve. But I think I'm pretty bullish, quite bullish.
Okay. Okay. And you said short-term hiccups. What could be those? Like, do we need to be really careful even now? Because one thing that I'm not sure is that there is a 60 days period of the final deal being signed.
Correct.
And there could be bumps ahead in that road. So is there anything more in terms of the short term? You said earnings wise, we're looking good now. Last 3 quarters have been good. Is there anything that we need to watch out for the short term?
Yeah, so I think earning sustainability, this pickup in earnings and the cyclical slowdown that we saw. So what happened, the problem, let's understand the context of it, right? So our problem started somewhere in 2024. Broadly speaking, if you understand in a very layman terms, so in India, EPS drivers are basically 3 factors. Exports, goods and services, both. The second one is government capex. Because post-COVID, government capex has become very large. Out of, let's say, 50 lakh crore budget, government capex is around 10 to 12 lakh crore, right? This year, they have projected 12 lakh crore around that number. Then there is a state budget, etc. So that becomes a very big driver of EPS growth. So actual that capex happening on ground is important.
Right.
The third thing is the domestic economy, the general what we do, activity, economic activity. These 3 things drive in layman terms broadly EPS for the companies. Now post-COVID everything was going good. There was a pent-up demand out from COVID and government capex was going up. Our exports were doing well, etc. So we had seen a very good earning trajectory post 2021.
Right.
Then in 24, all problems started, and they also coincided with other emerging markets and developed markets doing well.
Right.
So what happened in 24? That first in 23, somewhere around 23, this discussion started that America will go through recession. During the same time, China became very aggressive in export markets. Right. So they created massive capacity and they became very aggressive in export market. So because of this, both these 2 things, American recession expectation and Chinese competition, there was a hit on our export growth.
Right.
So our merchandise exports actually stopped growing. So if you look at now, they have again started growing. But if you look at number of non-oil, non-gold export, so virtually growth was 0.
Okay.
Very minimal, 3%, 4% in some months it was 0, etc. So that started hitting growth of the companies because we were seeing a lot of traction in export before this.
Right.
Same way, services were growing earlier at, let's say, 20% plus growth rate. That growth rate came down to 11, 12%.
Right.
Because of this American recession and all that. Then there was also base effect of heavy IT spending post-COVID. Because for 2-3 years, there was massive IT spending happening and that base effect was playing out. So this was one reason for our EPS downgrades. The second reason was in 24 May, we had elections.
Right.
And because of some reason or other, there was a slowdown in government capex. States also started getting into election mode, etc. And their capex was also hit because they were spending money on somewhere else. So that caused a lot of problem in terms of EPS for good number of companies.
Right.
And it also impacted spending and multiplier effect went down. That was second reason. Because of all this, and if you remember during that time, American recession was like a very prominent discussion point.
Yeah, 60%, 70% possibilities. Yeah.
Correct. So even domestic sentiment was negative.
Right.
And it also coincided with two things. Liquidity in the system was low and RBI kept system tight.
Right.
Inflation was low, but interest rate were not cut. So interest rate was also kind of supporting the tightening. And this went on for whole of 2024 calendar year.
Right.
The combination of all this drove a lot of earning downgrades. So there was a cyclical slowdown. Also during that time, government was consolidating its fiscal deficit. So the fiscal tailwind that was there post-COVID in the economy, that was slowly coming down. So that also impacted. So we call it cyclical slowdown.
Right.
It's not like a structural slowdown, but it's just a cyclical slowdown. Then came tariff problem. That also hit our export growth.
Right.
So all this resulted into earning downgrades.
Right.
During the same time, we saw other emerging market doing well. So even Japan was doing well, the developed markets, US was doing well, other emerging markets like South Korea, Taiwan, which were not doing well for last 10, 12 years, they started doing well. China started doing well. So a lot of money shifted there. Right? And that is why we saw FI selling, etc. So all this caused problem for us. Now let's examine how things have changed. So if you look at Q2 earnings, Q3 earnings, Q4 earnings, we have seen continuous improvement. Right? Interest rate have been cut, liquidity has been injected, tariff problem is behind us. And then suddenly this war came, which is also now behind us. Right? So if you look at all those factors which caused problem for us post 2024, they are now receding to a great extent.
Okay.
Right? And we are seeing that in number.
Right.
So if you listen to con calls of most of the export-oriented company in Q4, they are indicating that inquiry levels are going up. They are interacting and engaging more with their customer in US because the tariff pain is behind, the worry is behind. Right. So people are discussing more and more. So, and we even in the domestic side, we are seeing demand recovering big, and sustaining. So auto numbers, etc., doing well. In fact, in Q4, some of the consumer companies gave positive commentary.
Right.
So this all gives me confidence that we are seeing a improvement in the earning trajectory.
Okay.
So this should continue.
Right.
Of course, there is some El Nino worry and all that, but we don't have data to say that how much impact would be there. So with this crude prices going down, and there are certain estimates by some consultants and experts that post-December, we may see oversupply of crude.
Right.
So supply will exceed demand. So in fact, there are chances that crude can actually fall below current levels.
Right.
So now we are already at pre-war level today as we are recording. So we are already pre-war level in terms of Brent prices. And given that now Iran supply will come in, etc. Of course, Russia is a big black box right now. What will happen over there? But if nothing happens, then I think there is ample chance that crude may decline further, and it will be very good positive tailwind for us.
Okay.
Right? Because it will help us energy prices, having a lower energy prices, and which is a big input for us. Also, it helps us in our CAD, current account deficit. So I think if you look at all this, improvement in earnings, global sentiment, etc., I think I am quite positive. It should sustain. Right. That is my worry, that it should not get derailed further.
Yeah. Nothing new should come out.
Nothing new should come. Yes.
Okay. Excellent. So I think it's very important the way you describe the pain that we went through 24, 25 and how markets were bad. But when I was looking at your multicap, so Grow's multicap mutual fund, you have done phenomenally well, right? I mean, you see in the category, you have outperformed clearly. So I want to ask you, when the markets were bleeding, and especially in 2024, when everybody was saying small caps have a bubble.
Yeah.
Right, I remember. And actually, index level, there have been drawdown since then. How come Groww Multicap has done better than its peers within the category? What are the reasons that you guys have done well?
Yeah, so one is that we have been lucky that our calls have gone right. And so there are two reasons basically. So we launched in December 24.
Right.
And we were very clear in our communication that we believe that next 5 years and beyond, small caps and mid caps offer better opportunity for wealth creation as compared to large caps. So one theory that we followed is that we will have higher allocation to small caps and mid caps. And
Even though industry was saying opposite to it.
yes.
Right.
So what happens? So, see, the market with lot of skepticism is very good for professional money manager like me,
Right.
because I can buy at good prices, good stock, right? So when everybody is positive and stocks are going up like any crazy, right? Then it becomes very difficult for us. Because there is no sanity, right? The time you take to do research and understand companies, what they are doing, etc., stock will be up by 40%. So what do you do, right? So this kind of negative environment gives us great opportunity.
Okay.
And that also differentiates in terms of understanding. Because in a bull market, anybody can make money, right? You don't need to have understanding. You just need to have courage to buy.
Yeah.
But in a bad market, you need to have understanding so that you can differentiate. So I think that helped us. That environment was really bad, and we could do our job well. We could find out good opportunities, stocks at good prices, and we were very clear that there is an opportunity and there is a great opportunity to make money out there. And we followed it and we executed it. So since inception, we have kept highest allocation in our multi-cap fund to small caps. In fact, at one point of time, it was as high as 38-39%.
Oh my God. So wow. Okay.
So like 32, 33 to 39%. That has been the range. So you can say average around 34-35%. That has been the range of a small cap allocation in our multi-cap fund. And then was mid cap and then was large cap. So large cap was the smallest allocation.
Okay.
So, and it's a very difficult call to take that in a very difficult market.
Right.
In a market which is like confidence is really low, you go ahead and make a large cap lowest allocation.
Right.
But I think that worked for us.
Okay.
So that was one reason. The second reason was our philosophy. So the way we pick stocks, what we call is Q-GARP, the way we research and do the sizing in portfolio. I think that was another reason that helped us to be in a very difficult market to be in a disciplined mode and select right stocks.
Okay. So that's my next question. Then if the market is really difficult, everybody is talking about bubble in small caps or mid caps, valuations are very high, and then of course some correction happens. How do you find those quality stocks? What is the stock selection criteria? Because even right now, I see that there are stocks which are still all-time high.
Yeah.
And there are stocks which are, crashed by 40, especially the small caps.
Yeah.
If you look at across the sectors, there are stocks down by 40, 50%.
Correct.
How do you go and say that these will not fall further? How do you measure and how do you, what are your top 3, 4, 5 parameters which says that, I'm confident about this company?
Okay. So slightly longish answer I will give you to you. So we have a philosophy, what we call is Q-GARP, right? Quality and growth at reasonable price. So basically, essentially what we focus on quality, we focus on growth, and we focus on valuation. Essentially, it comes down to 3 things. Now, if you remove all these jargons, Q-GARP, etc., what we are trying to say, essentially you start with basic fundamental question, what you are trying to do. What is your objective? As a fund manager, my objective is to create compounding in my portfolio, right? Deliver compounding for my investors. That's my primary job. And that's the only objective I have. I have to make sure my portfolio is constructed in a way that it keeps on compounding based on best possible opportunities. How you do it? So you start with how you define the market, right? How you look at market, how you think about it. And then you come down to execution strategy. That how you will pick a stock, select a stocks, and how you will do sizing, etc. in the portfolio. So what we believe is that a stock market is a multi-factor, complex, evolving system. And now 3 words are very important. Multi-factor means that there are multiple variables which are impacting stock prices in, let's say, short-term, medium-term to long-term.
Okay.
Right? So we do not overemphasize on one factor. Right? We don't believe market is black and white. So it's somewhere in between, and you have to optimize between that. Another reason to optimize is that it's a complex system. Complex system means the relationship between 2 variables is not precisely defined.
Right.
So there is a relationship, but you don't know what is the extent of that relationship and how exactly it moves. For example, in books we are taught that interest rate and valuation have relationship. And it's a very inverse kind of relationship. Interest rate goes up, equity value comes down. Right? But in theory, there are times when it has never played out.
Right.
In fact, interest rates have gone up, equity valuations have also gone up. Last 5 year US has been a great example of that, right? So interest rate moved from 0 to let's say 4.5% now, 10-year yield, and equity valuations have also gone up. So this is why it's a complex system. To handle a complex system, you should not ask binary questions. You should optimize always, right? And you have to have continuous optimization kind of process to handle it. The third thing is market is an evolving system. It evolves. So as an investor, you have to evolve with it. For example, Warren Buffett teacher was Benjamin Graham. But Warren Buffett has evolved beyond Benjamin Graham, right? Because the context has changed, time has changed, etc., etc. So similarly, as a fund manager, as an investor, you have to evolve with the market. So when I say evolving with the market, you have to figure out pockets, right? And then kind of manage the risk within those pockets, etc. So pockets of growth, right? So when we say evolving with the market, we focus on growth. Right. Which are the pockets which are showing growth, and that is where we have to focus. We cannot be very restricted. We will look only in this pocket or that pocket, because then the compounding will get disrupted.
Right.
And the idea is we should not disrupt the compounding. Now, how we execute it at day-to-day level or in portfolio construction is that, so at broad level, what we do is that large caps, we do top down. So we take sectoral calls based on earning upgrade, downgrade kind of situation, and where we see earning upgrades may happen, or where we see positive surprises are coming in, there we go overweight on those sectors, and where we see downgrades are happening, we go underweight on those sectors.
Right.
And then we select a stock within those sectors.
So first sector and then
stocks, right? So in large cap, we do top down kind of thing. So I believe in large cap because the universe is small and sector weights are very skewed. Having a allocation call among sectors becomes more important than selection call.
Okay.
Yeah. Selection is important. I'm not saying that, but allocation is more important.
Right.
For example, if let's say IT or banking, if banking does well, the difference between performance of let's say top 3 banks and next 2 banks will not be much. There would be some difference, right? But if you have gone wrong on your banking allocation, even if you select the best stock, you may still underperform. Right. So in large cap, we do that.
Why in large cap you go with this approach? Any specific reason within large cap?
Because generally stocks within that sector, top 4-5 stocks, move in tandem.
Okay.
Right. Because if the sector is doing well, because these are mature companies, evolved sectors. So if sector cycle is positive, then almost everything will go up.
Okay, I see.
If sector's cycle is negative, then everything will go down, right? Or it will underperform.
Right.
So you have to take a call based on that. And it's a very narrow universe, right? Top 100 are the universe for the large cap. So you have to focus on sectors, so how sector rotation is happening, etc., relative value and all that. So that's why top down becomes important. Mid and small cap, we do bottom up.
Okay.
So there is nothing called 100% bottom up. You have to have some kind of top down approach in even mid and small caps, but the primary decision making happens bottom up.
Okay.
Right. Now, how we make decision? So as I said, we have multi-factor model, right? We believe in multi-factor. Stock market is a multi-factor model. So we have identified 5 factors that impact our investment decision to great extent, right? Or you can call them 5 risks for compounding.
Okay.
First is macro. Second is quality of management or promoters. Third is quality of business. Fourth is business cycle. And fifth is valuation.
Okay.
Essentially, in every decision making, when we are making an investment decision, we are thinking about these 5 factors. Macro risk cannot be preemptively incorporated into portfolio. Mm-hmm. That's very costly because it plays out over a long period of time, right? And the cost of hedging against a macro risk is very, very high. So you have to reactively manage it.
Right.
So whenever there is a macro risk, you have to react to it and then manage it, change your portfolio, etc. Other 4 risks you have to proactively manage,
okay,
right, or preemptively manage it. So the first 2 risks we never take. So we never take risk of management or promoters. We don't take risk of business. So what we call is quality of business and quality of management. We have a detailed process to assess them. So in case of management, there are 2 factors that we look: integrity, governance, and capability.
Right.
So integrity, governance, the established checklist that we go through in terms of capital allocation, etc., governance, board structure, history, shareholder friendliness, cash flows and all that, related party transaction. We do basic due diligence about the management, what they have done, what they have not done, etc. That gives us a decent check about the governance structure of the company. Then we come to capability. Capability is very, very important for us. Capability drives growth. Without capability, long-term compounding is not possible. So we ask ourselves this question again and again in any company that we want to examine and buy. Where is the capability? What is the capability? Is it product? It is scale? It is technology? It is client dependence, etc., etc. Because you have to have a clear-cut understanding of capability. Otherwise, it would be very difficult to have a medium to long-term view on the company.
Right.
Right? Especially small and mid-cap, because they are evolving. So even you don't know how the time will evolve, what would be the disruption. Suppose you are examining an engineering company right now, right? Now it makes, because it is a small, might be a limited set of products as of now. So you will have visibility maybe for 3 to 5 years. But the re-rating and de-rating of that stock will be driven by how the long-term outlook looks like. And that would be purely driven by capability. So you have to understand how capable this company is to expand its product horizon,
Right.
expand the set of clients that it can deal with. If it is supplying, let's say, to 3 OEMs, is it working hard and it is capable of supplying to next 3 OEMs so that it can de-risk, grow faster? How the market share gain will happen? What has been the history of market share gain? What type of innovation they have done? What type of talent they have been able to retain? Because talent brings capability, capability brings growth.
Right.
So we look at all those talent retention kind of thing for clients. What kind of people they are hiring? We want calibrated risk management in promoters and management. Right? We don't want reckless risk taking. We don't want zero risk taking.
Right.
Because both cases are wrong for us and not useful for us. Secondly, we want a good combination of entrepreneurship and professionalism. We don't want pure entrepreneurship because that makes scaling a business difficult, right? And we don't want too much of professionalism because then entrepreneurship takes a hit.
Right.
In a smaller companies, you need entrepreneurship so that he can take risk, he can think long term and build a business. Generally, professionals cannot think beyond medium term.
Right.
So building a business without entrepreneurship is difficult task, right? So we want a combination. So what we look at is in a business so then we comes to quality of business. So this is how we understand the capability part, and then we move to quality of business. Even if people are good, the business has also to be good quality. So what we look at is PSS framework. It's predictable, sustainable, scalable. So one is qualitative assessment of how predictable the business is, how sustainable the business is, how scalable the business is. We understand that by doing sector analysis, etc., competitive situation, all that thing. Then we look at basically 3 numbers. Operating cash flows, history of operating cash flow, how sustainable they are, ROEs, and incremental ROE in the business.
Right.
These are 3 very, very important factors for us. Incremental ROE is the ultimate driver of long-term re-rating and multiples for the stock.
Okay.
So in long run, the multiple that a business can command will actually dependent on its incremental ROE. So of course there is a base level ROE. It should not be too low. But at the same time, if incremental ROEs are good and high, businesses will command a very high multiple irrespective of growth. So for example, if I give, let's say the incremental ROE of a business is like, let's say 100% or beyond 100%. It means to generate incremental profit every year, it is not deploying any incremental capital. So let's say you start with a capital base of 1,000 rupees. You did a profit of 100 rupee in first year. Now for next year, you have capital base of 1,100. You have again redeployed the whole capital back into the business. And let's say you do 150 rupees of profit, right? Now on incremental 100 rupees, you made profit of 50 rupees. So your incremental ROC or ROE is 50%.
Right.
So that drives re-rating.
Okay.
Now suppose you get a business where you deployed 1,000 rupees, you did 100 rupees of profit, you took away 100 rupees through dividend, but you again made, let's say, 120 rupees profit. So your incremental capital return is kind of infinite because you are generating 20 rupees of incremental profit without deploying any single rupee of incremental capital.
Right.
You are taking capital away from the business, but you are still growing in terms of profit. So this business will command very high multiple, even if it is growing at 10-12%.
Yeah.
Right. So this incremental ROC becomes a very profound, important factor for us that we judge. And you have to do really hard work to figure out that how in next 5, 8, 10 year incremental capital returns or incremental return on equity will move out.
Yeah.
Right.
And for this, you will have to read both P&L and balance sheet because
Yes.
your equity is in the
Correct.
balance sheet
Yes.
and your profits are in
P&L.
P&L. So
Correct.
I'm just imagining doing this exercise if I was in your team, Anupam, that let's look at last 5 years
Yeah.
and every year see what is the profit and then look at the equity that has been deployed,
Correct.
arrive at ROE, then look at the next year and see what maybe plot it out
Correct.
and then see the pattern, whether
Yes.
the ROE incrementally is going up or not.
Correct.
Okay. I know it's beyond, maybe we might get into a lot of details here, but are there any ready-made indicators or tools that can plot it, or do you actually have to go and look into each of these balance sheet and P&L and then extract the data?
No, we have to do it.
We have to manually
So
do it.
yeah,
Okay.
so historically we get like Bloomberg's and AS equity and all those tools we use. Historical we can get it, but future projections we have to make. So what we call is financial modeling, right? So all our analysts will do that work and we will work together and discuss. And that is where the real crux of investing comes out, right? That how you think about panning out in next 5-7 years.
Right.
So what I have seen, and even today that mistake I make is, most of the time investors don't make mistake in understanding the business. They make mistake in valuing the business.
Right.
At least I have made more mistake in valuation rather than understanding a business. Understanding business in last 10-15 years has been very easy.
Okay.
Right? Because you have a lot of data. Company gives you a lot of data. There is Google and now ChatGPT, RAI that will give you a lot of industry report, etc., etc. And you have chart book of lot of foreign businesses which are similar to Indian business, so you know how it can evolve. But to think about future and building those perspective about how numbers will evolve, how ROE will evolve, how competition will evolve, how disruption will happen, how much company will be able to scale up, how much capital it will require, to reach to that level of growth, and then how market will value it. That's actually the most complex exercise that we do in terms of making an investment decision. And that drives a lot of our edge as compared to, let's say, so if you ask me what is edge between a professional money manager and a retail guy, it is only two. Ability to have this deep perspective about how business may evolve. And secondly is risk management, right? Because if you go wrong, how you handle it, right? We also go wrong, right? We go wrong more than a retail investor because we make more decisions.
Yeah.
But we have a kind of a playbook to handle those problems, etc. And that's what we call risk management. So this is about quality of business. These two risks we don't take. So it's like complete binary for us.
Quality of business and quality of management. You don't take any risk on
that.
Okay.
So even if we are like little bit of risk on business, we are not able to understand its sustainability, its incremental ROE improvement trajectory, cash flows trajectory, we will not touch that business.
Even if the stock is at 10 PE, for example.
Doesn't matter.
Doesn't matter what the valuations are.
Yes.
You will not invest, even look at that company if these two things are not there.
Correct. So as I said, we are a multi-factor model believer. So we don't start just with valuation.
Okay.
So just being cheap is not attractive enough for us to buy any stock.
Okay.
Right? Because we have to ask ourselves, see, market is not idiot, right? It's not stupid in long run.
Why is it trading at 10 or 15? Whatever.
Correct. So why nobody else is touching it? Right. There is a reason for that. And whether that reason can reverse or not. Now, you may debate that what is the reason for it, etc. It is a structural, cyclical, or some kind of a story. For example, between, let's say, 2015-16 to 19-20, when this ESG thing was very hot, right? All Indian coal-based utilities used to trade at very low multiples.
Right.
There was no problem with numbers. These are regulated entities, so their ROE is kind of assured. But the problem was in terms of a story, that where is the terminal value? Now, because at one fine day, because of this ESG, the whole business can become zero. Now, you don't know how you will handle that risk, etc. So you can take a very long-term call and say, okay, valuation is something that I like, and hence I will buy that stock. There is nothing wrong in it. But we don't follow that approach.
Okay.
We need to have at least a 3 to 5 year visibility on cycle.
Right.
Right. And in terms of what multiple company can command in the market, because our objective is to continuously compound. So we don't want to take any outsized risk, whether it is cheapness or expensiveness, right? On both sides.
Right. But this is one way of doing it. It's not.
Yes.
There are other ways where
Correct,
you
correct.
just pick the valuation which is lowest, and you say, you know what, in the next 5 years, the company will sort themselves out because we know the management is good, etc. So that is a different type of investing approach.
Correct.
You are saying you don't go with that. You
Correct.
first look at the quality of the business and quality of management.
Correct.
Great. Got it.
Yeah. So, for example, there is something called replacement cost theory. If market value is below replacement cost, you should buy. That indicates that it's like a blinder thing. I don't think so.
Okay.
We have seen some cases that for years, companies have traded at below replacement cost.
And they have remained below that.
They have remained below that.
Correct.
Right? Even today, some of the cement companies actually trade below replacement cost.
Yeah, I know. A couple of names come in my mind, and
Correct.
of course we can't name them.
And they have traded for last 8-10 years. So now if you believe that, and 10 years is a very long period of time. Right? So there is some questions that I think we need to answer in much more detailed way, and that is why we believe in multi-factor model. So we don't overemphasize on one factor.
And also the point you made about the correlation, the complexity.
Correct.
That two variables might not always behave the way
Correct.
you think that they should ideally.
Yeah. The way they were written in the book and we studied.
Okay, got it.
So that's one way of thinking. So now we come to business cycle and valuation.
Okay.
So once we have filtered the stock, you have created a universe. Now the question mark is when to buy and how much to buy. Right? Now that depends on the combination of cycle and valuation. So we are okay to create some valuation risk, but we are not okay to create portfolio level valuation risk.
What's the difference?
So basically, if cycle is very good and I have great visibility about cycle for let's say next 3 to 5 years, I may take a bit of valuation risk if I think exit multiples will sustain.
Right.
Right. For example, currently right now in some of the capital goods companies, etc., valuation risks are high. And we are taking that risk. We know that we have taken valuation risk. So if the earning trajectory goes below expectation level, then we have to take a call and exit the stock. Right. But we have taken that risk that yes, because earning trajectory is pretty sustainable, very good, looking quite positive, and next 3 to 5 years, there is a visibility given order book, etc., whatever macro analysis we are doing, we are willing to take that risk.
Okay.
But we don't want to create valuation risk at portfolio level. So whole of the portfolio should not be exposed to valuation risk.
Okay.
So there has to be some part of the portfolio where valuation and cycles are much more favorable as compared to, let's say, other part.
Yeah.
So what I do is I create sectoral diversification. So this is the way we manage business cycle risk, that my portfolio should not be exposed towards one cycle. So a lot of people think about stock level diversification. I think about sectoral diversification because I want to diversify among business cycles.
Right.
So for example, let's say you are very positive on IT. Now you go overweight on IT. Now if sector call goes wrong, whether you own 7 stocks or 1 stock, it doesn't make a difference.
Right.
Because in both the cases you will have drawdowns. So your sector call has to go right. Suppose you are exposed to, let's say, interest rate kind of or credit growth kind of sector, right? Whether you own a very good company growing at, let's say, 20% or you own a 15% growing company with some valuation differential, if there is a credit event happening, both will go down. So I want to have a cyclical diversification, not just stock diversification.
Right.
Right? And that's we kind of make sure to manage business cycle risk. So you'll have some export kind of opportunity, some domestic, some infra, some B2C, etc., that way.
Right.
And this is how we kind of manage. And then we also take a call on, so any company is basically going through 3 cycles, either in isolation, one of them, or combination. So every company in short term goes through inventory cycle, or what I call a sentiment cycle. So inventory, or let's say for some company order book, it goes up and down, so sentiment moves accordingly. And then re-rating, de-rating happens on those lines. For medium term, let's say 5 year, 4 to 5 year kind of cycle is capacity cycle or capex cycle. So people will be more positive. Re-rating will happen where capex is happening, growth is happening, right? Some companies doing capex, some companies not doing capex. Company doing capex will get further re-rated if cycle is positive. So we try to understand that. In long run, everything is a capability cycle. Long run growth, long term value is created by capability, nothing else. So we have to understand how this company is or this stock is placed in terms of these three cycles.
Right.
And accordingly, the multiple behaves differently. Right? Because they can go up and go down depending on how you are playing out in these three cycles. So we try to assess that and then try to figure out where the valuation is, how market will value it, what would be our exit multiple, and then we take a call in terms of sizing
Right.
in the portfolio. So valuation in business cycle becomes an optimization factor for us.
Okay.
So this is how we execute.
Yeah, this is quite a process, and for me, a couple of things that I'm taking back from this. One was the incremental ROE concept, and I think there you gave me two flavors. One is you put more equity, and then it gives you more incremental profits, and the second was that you keep your equity constant but still generate more profits, and both give you incremental ROE. That concept, I think, is going to stick with me for really, really long time. And the second aspect, that valuations are the secondary for you, because generally people say first एक बार valuations देख लो. If the valuations are good, attractive, then you look at other factors. That kind of investing style also I've seen.
Yeah.
But this is a very, very good process, and I think I'll want to bring it now to few sectors.
Sure.
Right. So let's see Indian IT sector right now. Okay. Lot of damage has happened. How do you see that now? If we put our lens of these parameters, how do we apply that into Indian IT sector?
Okay. So it's a tough question now.
I know it is very tough.
Yeah.
That's why I'm asking you.
Yeah. So how to look at it, right? So what drives multiple in a very academic sense for any company, right? Or valuation multiple, whatever you call PE or typical DCF, etc. So one is the growth in medium term. And then there is a concept called terminal value.
Right.
Right. That how this business will exist, let's say, if everything goes wrong, what would be the value? So let's say there is a branded company. If sales goes down, becomes zero, etc., there is a value in the brand. So somebody will pay something. So that's like terminal value or residual value for the business. Now, this temporary cyclical thing, upgrade, downgrade, what we call is basically earning cycle, upgrade earning cycle, downgrade earning cycle, drives multiple in a range. Because you are still believing there is a terminal value and there is a long-term value, right? So as I said, so let's say a company trading at 25-30%, delivering 25-30% ROE, and incremental ROEs are very high. Even if it is growing at, let's say, 8 to 12%, it will still command 20-25 P, right? Basically, ROE se thoda kam usko milega at a growth rate of, let's say, 8 to 10%. If growth rate goes little above, let's say 12, then the multiple will go north of 25, right? But now you bring to an equation that there is no terminal value.
Right.
Right? Forget growth. Eventually, the revenue will start declining and become zero because of AI. Right? In IT, in case of Indian IT sector. Now, jury is still out. But what market is sensing today? And if you look at some of the US companies, like one of the large US companies trading at 6p.
Correct.
Right? So, in terms of Indian IT companies, it will take at least 4 to 8 quarters for this question to be answered. Where is the terminal value?
Right.
We don't know yet, right? And of course, there is no scenario where you can say terminal value is zero. Because even with AI, and we are doing a lot of AI in our parent company, we do, and in my own team, we are doing a lot of AI. So we know that there will be requirement for IT services company. You cannot wish them away, whatever you want to say. So AI is not a tool where you push one button, press one button, and everything happens magically. That's not going to happen. And there are a lot of risk management involved, etc., etc. So there is terminal value. Question is how much, we don't know. And whether market will believe in that terminal value will still take time to establish.
Right.
So we have to wait and watch. I think valuations have corrected significantly, and maybe they are very close to the level where you are saying that there is no terminal value.
Is it? So that was my actually next question.
Yeah.
Is the market sensing that the terminal value of IT companies have come down drastically.
Correct.
And hence the PE multiples from
Have come
25, 32, it's come down to 15, 16 to
Correct.
large companies.
Yeah.
Is that what has actually happened here?
Yes. So
Okay.
there has been now a big destruction of terminal value expectation, right? So in that sense, I would say valuations have become relatively attractive, but I will still wait to take a call,
Okay.
right? So I will not go full aggressive on it. I will also not be zero on it.
Right.
So we are underweight in our portfolio.
We are
We
still
own
underweight?
IT. Yes.
Okay.
We own IT. In one of the fund, large cap side, we are equal weight types. In multicap, we are underweight. And we will continue to remain underweight in at least when the emergence of this terminal value comes back into the equation. That where is the terminal value? Now it's not about short-term growth. Everybody knows growth is not going to be there. We have been knowing it even 2 quarters before this.
Yeah.
So the hit that has happened, let's say in last 2-3 months, has been basis question mark on terminal value.
Right.
Right. So even 2-3 quarters ago, it's not that IT companies were growing at a very good rate.
No, I mean, it's been the same. Very
Correct.
Low single digit
Right.
growth.
So I think it will take at least 4 quarters for us to understand and for market to understand, and it may go both way, right? That even the current expectation of terminal value may go down, depending on how this plays out, AI thing plays out. But I think once companies are listed, so there is too much of hype around AI. It's not true.
Right.
So whatever is being propagated, that it will do this, it will do that, nobody will be needed, etc., that's not the case.
Right.
We have done it practically in our team, so we know it. Right? There's a huge amount of involvement is required, and it's very costly. So it's not about just capability; it's also cost that you have to see.
Right.
And economics will play out, right? So at some point of time, human intelligence, what you can call, because you are replacing artificial with human intelligence, right? It will also react in terms of pricing, and it may become cheaper than artificial intelligence. So then what happens? Right? And accordingly, the whole economics will change. So we have to wait and watch and see that what happens. And there is clear-cut overhyped situation because all the AI companies have to sell their shares, their IPOs, and they have to raise massive amount of capital. The quantum of investment is unbelievably large, right? They are talking about like $700-800 billion of capex, and this capex may continue for next 2-3 years at this rate, like $700-800 billion of capex. So I think they have to create this story to get that capital. There's nothing wrong in it, right? And genuinely, if they are doing so much, they have to be optimistic about it, and they need to believe in it, right?
Yeah.
But we need to wait and watch and see. At least in my experience, I have not found it to be as good as it is being hyped.
Yeah. There is a level of hypeness in that.
Correct.
But it's all... At the same time, it's not that AI is not changing the world. It definitely is doing some bits.
Yes,
of
correct. It's a profound
transformation.
technology.
Yeah.
No doubt about it. It's a very profound technology. But it's not as great as people are saying.
So your weight is that how much impact AI is actually likely to have on Indian IT services company, that is yet to be seen, and the money flow that goes with the AI that we need to see. So once in the next 4 to 8 quarters, the 3 biggies get listed, we get to see the true picture of what's actually happening.
So, you know what happens is the hype gets exaggerated because of 2 factors. One, nobody owns the stock. So as we say that real research stocks after you own it.
Yeah.
Right.
Yeah.
Before that, you are spending so much time, so you have a positive attitude, right?
Yeah.
That is why you are spending incremental time and you want to own it. So right now, because nobody owns AI stocks, everybody is positive about it. So let the people own it.
Right.
You know, in next 24 months, almost everybody will own it because everybody is excited. Some way or other, people will buy it, right? Some in large quantity, some in small quantity. That is one thing. And then the reality versus expectation will start getting into a sanity level.
Right.
The second thing is that every thematic company, when the theme starts, once it gets listed and once it reports 4 to 6 quarter of numbers, the hype gets a reality challenge.
Because shareholders starts questioning everything.
Right? Now you have hard numbers to see. So you cannot build like infinite story. Right? Now you cannot go to Mars when you have start reporting numbers, etc.
Yeah.
So you cannot like stretch your numbers and all that because you have a trajectory. So you will have a limited scope to play. Hype may still remain there. There is no doubt about it. But there is some sanity around it. So I think that will happen in next 4 to 8 quarters. And then we will have a better perspective about it, how things are happening.
Okay, Anupam, now that is understood. I want to ask you now, given that IT sector, you are underweight as of now, and it is to be evolved and to be seen in the next 4 to 8 quarters. But what are the sectors or themes, let's say top 3, that you are very bullish and you think the growth is there?
Okay, so medium term and let's say a bit 3 to 5 year thought
3 to 5
process,
years.
we are positive on 4 things. One is premium consumption. So anything associated with premium consumption, we are positive on that. So
Specific pocket in there?
let's say premium auto,
Okay.
etc.
SUVs and the high-end products basically.
Yeah, premium products, etc. Then we are positive on manufacturing exports.
Right.
It's a sector I think that will continue to grow, and we have to find good companies who can deliver, who can scale, who can build capability so that they can gain market share in export market. And there are companies in India now.
So manufacturing the products that
Yes.
are then built for export.
Yes.
Any examples of such businesses?
Engineering companies,
Engineering
auto
companies.
ancillaries,
Okay.
aerospace,
Right.
right? Indian companies are doing a good job, and they are getting capital, they are getting more confidence from their customers, etc. So they are expanding and they are growing, and opportunity size is very, very large,
Right.
right? So for example, just give you a perspective. US economy is roughly what, $30-35 trillion, right?
Yeah.
Around that number. Their manufacturing is between, let's say, what, 12 to 14% of the economy. So it itself is roughly around $4.5 trillion opportunity. India's GDP is like around 4, right? So if you can crack that and get some foothold into it, it can become a very large opportunity. Now, of course, you have to compete with China. But there are 2 things happening. China is not very good in niche products, which are very customized. And that is why some of our auto industry, auto ancillaries have done well. Right? So they are very good in very big mass volume products, like large volumes. They are very good. We cannot beat them. Second thing is that this whole China plus one, because of all that, people want to genuinely de-risk. Now it's upon us, our companies, Indian companies, to build capacity, build capability and deliver.
Right.
So in last 20 years, what has happened, that capital was not there for a lot of these smaller companies. So they couldn't build capacity. And for your client to trust you, you need to have capacity and ensure that supply chain is good. Now our infrastructure is good, right? So port capacity, etc., highways, railways, etc. So the logistics reliability and supply chain reliability is pretty good. So from that sense, I think we have a good right to win over here. Our engineering capabilities are phenomenal.
Right.
They are like world class. There is no issue on that. So in terms of designing a product, making it cost effective, etc., there is no problem. So I am quite positive on that area. Then there are 2 other areas, which is like transmission and distribution side. I think we need to build large capacity. Even the old capacity need to be renovated.
Right.
So it need to be replaced, because let's say, for example, a place like Bombay. Now Bombay power consumption is going up. So whatever T&D infrastructure you have, it has to be improved, upgraded, right? You have to put new capacity, etc., etc. So it not just incremental demand, which is growing, right? Because every year we broadly grow 5 to 7% in terms of our power demand. So that much extra capacity you have to build, and then you are like adding solar, renewable, etc. That is bringing in a different level of complexity into the system. So that has to be taken care of. Technological upgradation has to happen. So all these things are driving demand, right? So you have to find good companies over there and own it. We own a couple of them. And the 4th area is financials.
Right.
Especially non-banking financials. So spanning across NBFCs, or let's say non-lending financial companies like exchanges, etc., etc. So these are broadly 4 areas where we are positive.
Okay. And so I know T&D, transmission and distribution, some of the companies have gone crazy already.
Yeah.
So I think I was looking at that sector a couple of months back. I created a video on my channel talking about the entire high voltage DC current transmission and the differences, etc. My problem is there, the valuation. I mean, look at any company there. I mean, majority of them have run up already to the expectation that it's going to have a good tailwind. In that situation, how do you pick stocks? Do you look at whenever there's a correction in the valuations? I mean, timing is important there?
Yes. Yeah, very important. So in some of the companies we have exited.
Okay.
We made like more than 100% return, etc. In some companies we made 200% returns and then we exited.
Okay.
Right, and we will wait at some correction happen, or we find some cheaper alternatives,
Right.
which are kind of have same kind of growth driver, etc. But they are cheaper and they can deliver maybe, let's say, equal kind of growth. But this problem happens all the time. So for example, people are worried about 60-80 multiple now for these kind of companies. In previous cycle, these companies have commanded 120, 140 multiple.
Yeah.
If you go back 2005-6 wala cycle, the peak multiple that they commanded was like even 50% higher than current multiple. But I'm not saying that will come. It's not that kind of assertion or conclusion. But what happens is, again, incremental ROE.
Right.
These companies grow, they are running by like 300, 400% without putting a single amount of capital. Right. So if you look at a lot of these engineering companies, and if you look at how much capital actually they have put in balance sheet in last 4 years, it would be virtually nothing. And they are growing like at 50%, 100%. So these high incremental ROE companies command very high multiple.
Right.
And of course, then this is cyclical, thematic, etc. So a lot of people come and buy these stocks, and now there is passive flow, which are buying blindly. There is no concept of valuation over there.
Right.
So all those things create a hype. So you have to be very, very careful.
Right.
Being a positive on sector doesn't mean you will make money in all those stocks.
Yeah. Of course.
So you have to be very, very careful, and it's a multi-factor model. So valuation is important. It may not be the starting point, but it's important point. It's a very, very important point. So what we do is we keep on churning our portfolio, optimizing our portfolio basis cycle and valuation.
Right. And going forward as well, you in your Groww Multicap, would you continue to be heavy on small cap and mid caps?
Yes.
Is that the plan?
Yes.
Okay.
Correct. So what we believe is that in next 5 to 10 years, we are very confident that we are going to see more compounding and better opportunity of wealth creation in small and mid cap. And it's a very simple reason, that theory I have. It's about access to talent, access to capital, access to customer.
Right.
The traditional or historical problem of a small cap is these three. They don't get access to best talent, or they never used to get access to best talent. Right?
Nobody wants to work for them. I mean,
Correct.
less people want to work for smaller companies.
15, 20 years ago, the best talent wanted to go out of India. Then the remaining best talent used to work for large companies, MNCs, etc. Now things have changed. So 3 things have happened. Number 1, that people now want to work in smaller companies. Young talent, etc. They want to join startups. I am seeing this a very good culture. A lot of people, when we started Groww AMC 3 years ago, they applied and from good institutions, and they clearly stated that we want to work because it is a startup.
Right. Okay.
And I was actually very positively surprised that yes, that's a very good thing, right? To work in a very small new company. But especially in tech space, manufacturing space, people are working. The second thing is that large companies over last 20-25 years have created a massively large talent pool, experienced talent pool. And some of them are really financially secured, and they want to take that risk and go to smaller companies, work there, and smaller companies benefit out of them. So there are multiple IT companies actually. Their destinies changed. They became multi-bagger when the top management came from larger companies.
Right.
And there are examples of that. Similar things have happened in some of the chemical companies, engineering companies. So it helps a lot, right? Because you come with a lot of learning about system, processes, how to access client, etc.
You make a small company a bit more mature and system-driven, process-driven, etc. Okay.
And for smaller companies, promoters have also becoming now more open to professionalize the business.
Right.
Earlier there used to be big challenge culturally. Yeah, this is one more reason, why we remain very positive about India, etc. is that the quality of entrepreneurship in India is changing very fast. It is improving. So if you look at a traditional 25-year-old car entrepreneur, the entrepreneur that existed 25, 30 years ago, and today's entrepreneur, they are very different, very, very different. And they are much better. They have a more, you can say, professional and competitive positioning rather than I was from a business family, I had money, so I have become entrepreneur. Right? Because you were just at the right place at the right time.
Yeah, there is more fire now.
More fire, more capability now. And ability to create further capability is very good.
Yeah.
And a lot of old style promoters failed because of that. That they couldn't scale business on capability point. And that's very important because capability brings growth. So that's another thing that is happening. And the third thing is that general availability of talent in India has improved. So now we have more engineers, more MBAs, etc., etc. Internet has made people more knowledgeable and aware.
Right.
And again, that is where I believe that ChatGPT or AI will help India become much better
Right.
in terms of figuring out products, processes, systems, doing things fast, right? Learning very fast. Internet actually changed India a lot. We don't appreciate it, but especially in tier 2, tier 3 towns, the capability improvement that happened was primarily driven by internet.
Right.
Availability of YouTube, etc., etc. So AI will further it, make it further progress on it. So I think these three things are the most important factor. Talent brings capability, capability brings growth.
Yeah.
The second thing is access to capital. So India is short of capital. 20 years ago, it was massively short on capital, right? Why foreigners own so much of our equity?
Yeah.
Because we never had capital.
Yeah.
We wanted growth capital. So we have to go to foreigners and request them to please invest in India. And they were wise enough to invest in India and they made great money, right? So now capital availability is great. If you look at private equity funds, even domestic private equity funds are doing great. They are raising money, etc., and investing. Venture capital funds are there. Mutual funds have become very large. So somebody was telling me, I have not exactly checked this data, that the total AUM of small cap funds now is bigger than the total equity AUM mutual fund 16, 17 years ago.
Right. Okay. So the small cap itself has become such big.
Yeah.
Okay.
Correct. And this small cap is essentially growth capital because we provide. So total equity AUM is roughly around 45 lakh crore, right? Now suppose that we give 2% of this as growth capital to companies. That itself is like 90,000 crore.
Yeah.
Right.
Yeah.
So capital availability has become really good, not just risk capital but also debt capital. Because between after 2008 global financial crisis, we went through a massive banking crisis. Right. So even debt availability was a big problem in India, especially for smaller companies. Smaller companies need capital to grow.
Right.
Right. And during those times, between let's say 2010 and 11 to especially 11 to 19, there was no risk capital available for smaller companies. Everybody just wanted to buy large caps. And there was no debt capital available because private banks were not doing corporate lending or business lending. It's only PSU banks who were doing it. PSU banks were in bad shape. Right? So there was no capital available and we went through a lot of pain because of that. But now we have sorted it out. So now even we have a lot of NBFCs, etc., who are focused on MSME, SME. We have banks doing SME lending. We have private equity, etc., who are debt-specific private equities, credit funds, AIF-driven credit funds, etc. So I think capital availability has improved dramatically. The third thing is access to customer. So when I started my career way back, and let's say when I started in stock market in 99-2000, the theory was that what is the moat of a what is the moat of a consumer company? It's distribution.
Right.
Like 500,000 shops have its products.
Yeah.
And you cannot enter those shops. So that is the moat. That is the competitive advantage. Now with online and e-commerce, etc., anybody can create a brand and you can supply. We have created a phenomenally efficient logistic sector and supply chain system in India because of e-commerce in last 10 years. If you ask me what is the most remarkable achievement of e-commerce in India, it is supply chain.
Right.
My parents stay in a small village in Madhya Pradesh. I order certain things, 150 to 100 rupees, and they stay in a village, which is like 25 kilometers away from district headquarters. And one online company delivers it to them. Like 150 to 100 rupees thing. It's amazing, right? And actually it has brought in structural efficiency into the system. And that is why actually we have also been able to control a bit of inflation. Because the supply chain bottlenecks have gone. So this access to customer has become very, very good. And that is driving a lot of businesses, D2C brand, etc., etc. And we have seen a lot of listing across that space. Even on export side, because we have done a lot of hard work in pharma industry, IT industry, recognition has gone up. Our infrastructure has improved, so supply chain reliability has gone up. And all that is giving us much better access to customers in export market.
Right.
So I think all these three factors, access to talent, access to capital, and access to customer, These three things are my primary basic argument for being positive on small caps in next 10 years.
Right.
And as economy grows, you create opportunity for new businesses, etc.
Absolutely.
Right? So that's given.
Yeah. Also, I think you've, in the last 5 minutes when you were narrating these three points, my take was that there are a lot of positive things you talked about India as a whole. There's a lot of negativity right now about India economy, stock market, because what have we done in IT, etc. Oil prices, there is a huge dependency. It's like the entire narrative that used to be really good up until September 2024 when this market crash or correction happened was very positive, and it turned all of a sudden negative. Everybody's become an expert on macros, etc. On Twitter, you go. That's why I hardly go on Twitter because everybody's such giving so much of gyan about India. This segment, I think, is crucial for my viewers to understand that it's not all doom and gloom. There's a lot of good work that is happening in India, and we should remain positive about our country and economy. So thank you for that. There are few 1-minute questions,
Sure.
Anupam. One is, one big mistake investors must avoid in 2026.
Forgetting their previous mistakes.
Right, very good. If you had to pick only one sector or theme for the next 5 years, which would that be?
I think manufacturing exports.
So out of the 4 you said,
Yeah,
manufacturing
exactly.
export is the one. Okay. Your biggest investing mistake so far?
Sometime I miss hard work. I don't do hard work. Right. So, I take shortcuts.
Right.
I think that has not paid well for me. So I think.
You're being really, really honest. People don't really, generally share their shortcomings, and it's really glad that you're doing that. So thank you for doing that. Your biggest investing success so far?
Yeah. So it's a bit long story, not very long story, but so there was a company I used to own, and there was a open offer on that because the company was sold to another investor, and there was an open offer. And in any open offer, there are arbitrage opportunity, right? So people were doing arbitrage. And one fine day, I was owner of that stock. And one fine day, I looked at the future price and the current stock price, and I said, boss, this doesn't look good. So I did a lot of calculation around that. And so in an open offer, when you have a tender offer, basically the arbitrage opportunity is basically dependent on acceptance ratio. That how much shares you need to tender and how much will get accepted. And accordingly, you need to short the remaining part so that you are neutral. Right? When I made that calculation, and I realized that people are actually going with a lower acceptance ratio.
Right.
The acceptance ratio would be much higher. And I couldn't find out a reason why. But I was very clear. So I asked a couple of people in the market, then they said, no, this calculation is correct and this should be the acceptance ratio. And my belief was that this much amount of tendering will not happen. Because of some reason, I don't want to disclose that. But I was very clear that, and I was a large shareholder in the company, that this much of tendering will not happen. So I went against the arbitrageurs. And I bought all the futures that were being sold because the future price was at a steep discount to the stock price. I even bought the stock price. I even buy the stock in cash market. And I think in 1 month, my fund was up by 5%.
Wow.
When market was negative. Just because of one position. And I built like a reasonably sizable position. And so I think that was one of the very prominent that I still remember. There have been a couple of other also.
Your favorite investor of all time?
No, not single one, but multiple ones. I believe in multi-factor model. So I also believe in multiple guides.
So who are those multiple? Let's say top 3.
So I have learned a lot from my peers, the people I work with. So I started my career in Reliance Mutual Fund.
Right.
Now called Nippon Mutual Fund. And there were like 4 great guys that I worked with. So Madhusudan Kela, he's now an individual investor. I was his executive assistant also for some period of time, and he was our head of equity, our boss. And very different personality, a very unique perspective of managing money, buying a stock, etc. Sunil Singhania, he was the senior fund manager. He now runs Abacus. He owns it. He was there. Again, very different person. Then Ashwini Kumar, he now works with Prashant Jain in 3P. He was there. Again, very different person. And then Shailesh Bhan, he's now CIO of Nippon Mutual Fund.
Right.
These 4 people I used to work with. I used to report to all of them because as an analyst, you have to work with all of them. And Madhu, I used to work closely because I was executive assistant to him. All four were different. There was no commonality in even on 10% commonality between them, or among them, right? So that was like greatest exposure of my life and my career.
4 good guys, experts in one particular company.
And different.
Right. Yeah.
All used to think very differently. You know, so Sunil was very value oriented. Shailesh had great insight into how to think about businesses, how to build framework. Ashwini was great into cyclical business, how to think about it. So the first stock that I made great money as a fund manager first time was because of understanding from Ashwini. So there was an auto company and there was a lot of misbelief about it was launching a product and how much product it can sell, etc. And with whatever I have learned, I had learned during that point of time, and Ashwini is a great expert on auto. Whatever he had taught me, I could figure out that this volume would be higher than what market is expecting. And that would drive a lot of re-rating and earning upgrade, etc. Then I built a large position and made great money. It was almost like a large cap was like 5-bagger for me.
Right.
In a matter of 2 years. So I have learned from all these guys. Then I went to principal. PVK Mohan was our head of equity, great value investor, amazingly understanding of deep value investing. Then I went to Axis, Shreyas and Jinesh. Both were very intelligent, sharp guys, very different perspective. And of course, Warren Buffett is a great institution to learn from. Somebody, some other like David Dreman, has written a very good book, Contrarian Investment Strategies. Very practical book for fund managers.
Right.
It may not be great for retail investors, but for me, it's a very great book. I read it again and again multiple times. So I think these have been people with whom, so mostly people with whom I have worked with. The good thing about our industry is that it has a amazingly great collection of talent and capability. You know, people are immensely capable in our industry. So you can learn from them. You know, the way they construct portfolio, the way they think, and everybody is different. So you always get a very different perspective about seeing things and learning.
Right.
So I think that has been my learning source.
Yeah. Really good. You gave me good names for my podcast if they accept. One investing book that everyone must read.
So I think to start with, 5 Rules for Successful Stock Investing by Pat Dorsey is a great book. Every entry-level investor, even let's say a beginner should read it. Then Seeking Wisdom by Peter Bevelin, I think is a great book. And of course, everybody should read Letters to Shareholder by Warren Buffett. I think it's must. The great thing about them is it gives you a very big, very strong foundation how to build your thought process. And the older shareholder letters, let's say around 60s, 70s, the good thing is, so right now US market is very different from India market. It's very purely innovation tech driven. So there is no correlation. But if you go back 50, 60 years, the US market was pretty much what India market is, like diversified, consumers, healthcare, all those things, brand, financial services. And he has talked about those things. So you'll get a very good perspective if you actually read old letters, the oldest ones like 60s, 70s, and all those times. So I think that should be must for every investor.
On that note, I think this was such a power-packed session. Anupam, thank you so much. I've learned a lot in this one. We have gone right from top view to then detailing of how to pick stocks to themes, etc. And your personal insights and the way you've explained things, simple, easy. I'm sure my viewers would have loved it. Thank you so much once again.
Thank you, Rahul. Thanks a lot for inviting me here.
Thank you. Thank you.
If you haven't yet subscribed to our channel, humble request that you hit the subscribe button now, because your subscription is our motivation. My team and me gets really motivated once we see your subscription. So please hit the subscribe button now, and I'm going to see you very soon. Until then, keep rocking.